Good afternoon, everyone. I'm Shira Zimmerman, Investor Relations Manager for the Trendlines Group. Today, Steve Rhodes and Todd Dollinger, Chairs and Chief Executive Officers of the Trendlines Group, join us from Singapore. And Chaim Brosh, Trendlines CFO, is here with me in Israel. They will present business updates and a financial overview for the half year of 2023 and answer questions at the end. We are also pleased that Eric Lowe, the CEO of Trendlines Medical Singapore, will join us today to briefly introduce the medtech incubator and its activities in Singapore. To submit a question to our management team, please use the Q&A function in the conference call. Please note that this presentation may contain comments and constitute forward-looking statements which involve risks and uncertainties. Examples of forward-looking statements include descriptions regarding the intent, belief, or current expectations of the company or its officers with respect to future results of business operations and financial condition, industry, environment, and future events and plans of the company. Such forward-looking statements are not guarantees of future results, performance, or achievements. Actual results, performance, or achievements of the company may differ from those expressed in the forward-looking statements as a result of various factors, such as known and unknown risks and uncertainties, and assumptions, including those risk factors discussed in Trendlines' offer document dated 16 November 2015. In the company's filings on the SGXnet, which you are encouraged to review. By their nature, forward-looking statements involve risks and uncertainties because they relate to events and depend on circumstances that may or may not occur in the future. In light of these risks and uncertainties, actual events, results, and developments could differ materially from those expressed or implied by the forward-looking statements. The statements represent the company's or its officers' views only as of the date they are made and should not be relied upon as representing the company's or its officers' views as of any subsequent date. The company does not assume any obligation to update forward-looking statements. These are the topics we'll be covering today. As mentioned, as part of our overview today, Eric Lowe, the CEO of Trendlines Medical Singapore, will expand on his team's activities in Singapore. Finally, please note, all monetary values are cited in US dollars unless otherwise specified. I'll now turn the presentation over to Steve Rhodes, Chair and CEO of the Trendlines Group.
Thank you, Shira. We're particularly pleased to be on the call today from Singapore in the offices of Trendlines Medical Singapore. And we want to thank Eric Lowe, the CEO of Trendlines Medical Singapore, for his hospitality and for joining us today. We're going to start with a quick overview of Trendlines for those of you who are less familiar with us, giving you a snapshot of who we are and what we do. Trendlines invests in two areas: agri-food technologies and medtech. We invest in these fields in support of our mission of investing to improve the human condition. We have 16 years of experience in funding and building early-stage companies from seed to exit. Today, we have a portfolio of some 54 companies at various life cycle stages. Of those, 20 are more advanced or mature companies, meaning they have achieved significant developmental milestones, and some are already producing revenues. To date, we have taken 2 of our portfolio companies public, and we have exited 10 companies. Our goal is, of course, to increase dramatically the number of exits over the years. Here's a snapshot of our earnings highlights for the first half of 2023, which our CFO, Chaim Brosh, will review in more detail later on in the call. Just to remind you, in November of last year, we announced our strategic transformation for the company. A significant shift in company strategy. Key elements of the plan were to suspend investments in new companies and focus on nurturing our existing portfolio, all while reducing operating costs. We're pleased that we already see the positive results of this strategic shift in our first half results, as reported at the end of just a week or so. During the first half of the year, we made meaningful progress. We recorded a $16 million turnaround in profits, reporting a $4.3 million first half gain compared to a loss of $11.9 million the same period last year. Our book value increased to $104 million compared to $95.9 million at the end of 2022. And the value of our portfolio, which is the most important measure we believe of our value and performance, grew from $89 million at the end of the year to over $101 million at the end of June. Significantly, the non-IFRS value, which we began reporting this year for the first time, is 50% higher than the IFRS fair value in our books, over $152 million. Just to remind you, the non-IFRS value is calculated by including the value of consolidated companies, ignoring discounts for holding ordinary shares in selected companies, and looking at the valuation caps used in safe transactions. The growth in our portfolio is due to the many achievements of our companies during the first half of 2023. These achievements reflect a maturing portfolio with follow-on capital successfully raised by companies, often with larger raises and at higher valuations. Achievement of significant milestones is, we believe, an important step towards significant exits ahead for our portfolio. Since it is a challenge for investors to really dig in and truly understand all of our companies, we encourage you to note the achievements of mature companies that are ramping up with significant milestones. It is the sum of these remarkable stories that is the value of Trendlines. Even with the current challenging macroeconomic environment, a number of our portfolio companies completed significant raises the first half of the year. Just to mention a few, Escala Medical, which we hosted, as you may remember, at our last business update, received a 5.5 million euro grant and equity investment from the European Innovation Council for the commercialization of their revolutionary decisionless pelvic organ prolapse treatment for women. This funding comes soon after the company received FDA clearance. The company serves a huge market need, and we're extremely excited to see their great progress as they begin to enter the US market. Reports from the first American surgeons who use the device have been completely positive, even, I would say, exciting. Singapore-based Insecta written 1.4 million Sing dollars to scale its biomaterial extraction from insects. The funds will be used to set up a new manufacturing facility, allowing Insecta to increase its production capacity by a factor of 30. Insecta's patented extraction process allows them to derive highly sought-after, highly expensive functional products, including chitosan and melamine, from the waste product of black soldier fly farms. These biomaterials are in high demand by many industries and sell at a high premium. Our portfolio company, Pregnantech, raised $2 million during the half for further clinical trials of their preterm birth prevention device. The company has had very successful results from its first clinical trial, pregnant women, and in 2024 will initiate a much larger pivotal trial with the eye of getting a regulatory approval thereafter. Bioefficiency and Alga Health have both signed collaboration agreements to advance their companies in the market. Bioefficiency signed a distribution agreement with Utex, a leading Chinese aquaculture solutions provider, while Alga Health recently entered into a cooperation agreement with South Korean Huan's Foodians, a member of the Huan's Group, a global healthcare company. In addition, on the medical side, our portfolio company CenterCare, which is developing technology to enable aging at home, aging in place for the elderly, signed a cooperation agreement with the Zomi Med Alliance from Japan. A number of our companies have also recently received regulatory recognition and approval. Liberty, which developed the digital dialysis clinic for home dialysis, received FDA clearance for its unique cost-saving system. Olmec Medical received FDA clearance for its smart device for epidural injections, and Escala, who we've already mentioned, received FDA clearance for their second-generation device, paving the way for entry into the US market, supported by the €5.5 million investment from the EU. Some 9 companies launched or continued clinical or field trials to advance the regulatory and commercial goals. Every successful clinical or field trial brings our companies closer to increased valuations, sales, and potential exits. These are just a few of the highlights from the first half of the year. I'd like to turn the presentation over now to Todd Dollinger, Chair and CEO of the Trendlines Group, to give an overview of our portfolio.
Thanks, Steve. So as Steve said, I'm going to give a quick overview of some of our leading portfolio companies. We believe strongly that the best way to understand Trendlines and the value that we've created is by looking closely at our portfolio companies. Beside the specific achievements that we've reviewed just now, we'll spend the next few minutes getting a taste of some of the other companies in our portfolio. First, let's take a look at our portfolio by the numbers. Of our over 54 portfolio companies, 20 are in the agri-food sector and 34 are medtech companies. 17 companies are defined by us as revenue stage companies. They're already selling products into the market. About 20 companies have a strategic partner on board. 8 of the companies, medtech companies in our medtech incubator in Singapore, are actually consolidated into our financial statements and therefore do not express value on our balance sheet. This is why we produce IFRS numbers and, for your further review, non-IFRS numbers. Now, we've mentioned a number of Escala's achievements today. The company's made significant progress in the last year with FDA clearance for their second generation device, with amazing results from the clinical studies that have started up and their work in the US. And as Steve just mentioned, a reward of a non-dilutive grant funding from the European Innovation Council, in addition to potential equity investment from the EIC. A total of over €5 million between those two financial instruments. This company is led by Dr. Edith Goldberg, and together with a strong team, including a very active chair, they are poised to propel the company forward to market penetration and, we believe, substantial success for all of the investors. Now, let's just do a quick review of some of the leading medtech companies beyond Escala. So, on the medtech side of our business here, our focus today is on these 4 leading companies. And we know that 3 of them have achieved regulatory clearance already, which is a very important step in achieving value for a company and moving it toward exit. And 2 of these companies have already launched sales. Arcuro has FDA clearance and CE mark and has launched sales in the US and Latin America. The company is working with some of the most important key opinion leaders in sports medicine and is marketing its meniscus repair device as the clearly superior device for faster, easier surgeries. Arcuro, led by CEO and founder Lee Ranone, together with a strong management team and advisory teams, is moving forward with their American market penetration. Specime Medical has developed a disruptive solution for bladder cancer treatment using cryotherapy. The company recently finalized clinical studies at Rambam Healthcare Campus in Israel with very promising initial results. A multinational company has expressed ongoing interest in their process, and we look forward to making announcements about that before long. Seritrieve has developed a complete ischemic stroke clot extraction device. The company has done clinical work with 12 patients in a first-in-human study with very promising results, and this has resulted in growing interest from investors and potential strategic partners and acquirers alike. The company recently closed a $4 million funding round. Pregnantech, as their name suggests, is a game-changing device to prevent preterm birth. They recently completed a successful clinical study in which it was demonstrated that we can dramatically reduce the risk of preterm birth in mothers at risk. And now I'm going to turn things back to Steve, who's going to review some of the agri-food companies in more detail.
Thanks. Trendlines, who has also presented to us in the past, continues to make amazing progress in their quest to produce completely natural, stable food colors using fermentation process. In other words, natural food colors without the agriculture. The goal of the industry is to eliminate the use of artificial colors and go to natural food colors. But natural food colors have many problems. Phytolon addresses and solves all of those problems. Last year, Phytolon announced the completion of a $14.5 million investment round. And this year, they continue to make amazing progress, including progress towards raising additional capital at an increased valuation. Phytolon has captured the attention of industry leaders, including global food giant DSM, which was an investor in the round, and synthetic biology leader Ginkgo Bioworks, which also invested in the round. Other investors in the round included leading Israeli and European VCs. We expect this company to have tremendous success in the near future. Additional companies in the portfolio that we'd like to sample have made great progress and represent the high caliber of companies in our portfolio. All four of the companies you see here have completed investment rounds to expand their capabilities, and all have strategic collaborations with multinational corporations already signed or in the offing. Historically, of course, and we can't say what will happen in the future, but historically, in many cases, the multinational signing is a precursor of acquiring companies later on. IBI Ag is one of the four companies established by the Bayer Trendlines Innovation Fund. IBI Ag develops biological, environmentally friendly technology to control insects. The company recently brought on a new CEO, and Bob Woods, former senior executive at Syngenta and Marrone Bio, has just joined the company as the chairman of its board of directors. The company has begun greenhouse trials of its solutions. MetaMotion, with its strategic collaboration with Netherlands company Ritter, ramped up production and has begun sales in 2023 of its AI-based autonomous robot for greenhouses. The company's robots are already in use in Europe and in China. AgriScout has continued widening its customer base, adding AECI, the largest agricultural distributor in South Africa, among others, and deepening its strategic cooperation with DJI, the world's #1 drone company. AgriScout recently completed the prestigious Google for Startups European program as well. Finally, Biaqua is poised to launch its first product, is expanding its pipeline by adding additional diseases and new species, including barramundi, in cooperation with a Singapore partner. Phytolon and these four companies represent just a taste of our 20 agri-food companies. Let's move on and take a look at some of our key financial metrics, starting with a look at our portfolio valuations and breakdowns. In the last 15.5 years, the total portfolio value created, including cumulative exit proceeds of $49 million, reached $151.4 million at the end of the first half of 2020. It's important to note that this cumulative value does not include the value of our consolidated Singapore companies. At the end of June 2023, the fair value of the Trendlines portfolio was $101.1 million, compared to $89.8 million as of December 31, 2022, 12.5% increase over 6 months. Balancing our desire for greater transparency with our need to protect the sensitive information of our portfolio companies, we are now providing information on our portfolio value through cluster-based valuations in our reporting. In this table, you can see the 12 clusters with the total value of Trendlines share in these clusters, based both on the IFRS value in our audited financial statements and value based on non-IFRS information. With this additional information, we are now giving shareholders a new prism through which to view our portfolio and its value. In the same way that management uses the non-IFRS value information, this information is an important tool for investors. As you can see on this slide, the overall non-IFRS value of our portfolio was $152.8 million at the end of June 23, 51% greater than the $101.1 million IFRS reported value. The non-IFRS values were calculated by adding in the values of our consolidated companies, eliminating the discount that is applied when a company raises funds with for shares using the capped valuations of safe rounds as a substitute.
Okay.
Okay. So I just wanted to come back to the slide for just 30 seconds, since we spoke about it at length without having it in front of us. You can see here the list of all of the clusters, and next to the cluster is the amount of that it represents in our books, as well as the non-IFRS value. And if you take a look at our investor presentation, which was posted a couple of days ago to our website into the SGX, you can also see the names of the companies in each of the clusters. So you can see how many companies are in each cluster, the names of the companies, and the valuation. It's important information. Down at the bottom, you can also see the change from December 31st to June 30th. And let's move to slide 17, book value versus exit value. As we've shared with you in the past, here you can see that the average value of our exits is more than 4 times the IFRS value prior to exit. Assuming past experience provides some indication of the future, this multiple represents an important indication of the potential for future exits. I'm now going to hand the presentation over to Chaim Brosh, our CFO, for an overview of our financial metrics.
Thank you, Steve. Here is an overview of our key financial metrics. As mentioned earlier, our portfolio value increased by 12.5% compared to the end of 2022. This was mainly due to an increase in value of several of our portfolio companies. Our total equity increased by 8.5%, mainly due to the continuation of our PIPE fundraising in tranches, total of $3.7 million during the first half of the year, and $4.3 million profit generated during the first half of 2023. Our NAV per share remains stable at 11 US cents per share, the equivalent of 15 Singapore cents per share. We reported a net profit for the first half of 2023 of $4.3 million, compared to a net loss of $11.9 million for the first half of 2022. Total assets increased by approximately 6% from $108 million as of December 31st, 2022 to $114.5 million as of the end of June this year. This was mainly due to the increase in the fair value of the investment in our portfolio companies of approximately $11 million. Our total short-term liability amounted to $4.6 million, a decrease of $2.2 million compared to the end of 2022, mainly due to the reduction in trade and other payable. Our long-term liability amounted to approximately $5.8 million as of the end of June 2023, a slight increase compared to the end of 2022. 3 major liabilities components are the deferred tax, which represent the theoretical tax liability that is occurred when there is an increase in the carrying value of our investment portfolio. These taxes only come due when exit occur. Second is the loans from the Israel Innovation Authority, total fair value of $2.8 million. And the third revenue represent our commitment to provide services to our portfolio companies. None of those 3 liabilities has due date for payment. All are only payable upon exit event. Our total income reached to $12.4 million in the first half of 2023, as compared to $4.9 million loss in the first half of 2022. In first half of 2023, we saw a gain of $9.2 million from the change in the fair value of portfolio companies, compared to a loss of $7.4 million on the first half of 2022. The gain was as a result of factors such as the favorable terms in which portfolio companies completed fundraising exercise and portfolio companies' commercial or technological progresses. Trendlines reduced its general and administrative costs in the first half of the year by approximately 11% compared to the same period in 2022. We were pleased to report the $4.3 million net profit for the first half of this year, representing a $16 million turnaround from the net loss of $12 million on the first half of 2022, primarily due to the increase in the value of certain of our portfolio companies. I'd like now to introduce Eric Law, our CEO of Trendlines Medical Singapore, who will update on the activities of his team in Singapore. Eric, please.
Thank you, Chaim, and good afternoon to everyone. I'm very pleased to be here to give a very brief update on Trendlines Medical Singapore. We established the incubator and our activities in the medical tech field or the medtech field in Singapore in 2017. Our vision was to invest in and provide intense support for Singaporean startups developing advanced medical devices and technologies, following the Trendlines incubation model that has been well established in Israel. This incubator deepens Trendlines' involvement in and impact on the local market. Currently, we have 8 active portfolio companies established based on ideas from local and overseas and led by entrepreneurial CEOs or as spin-offs that were from the Trendlines Innovation Labs technologies. We actively partner with institutions like the National Healthcare Group and other healthcare institutions to develop the early-stage medtech concepts with involvement of physicians to align with clinical needs. It is also a privilege that our portfolio companies enjoy the strong support from government agencies such as the Enterprise Singapore that provides developmental grants and facilitates strong connectivity to the local and overseas medtech ecosystems. One of our portfolio company that I like to talk about is Nonsurgical Solutions Medical Private Limited. Nonsurgical is one of our portfolio companies that is involved in developing a new surgical instrument that enables the resection of diseased colon without any incision, or what we call intracorporeal anastomosis. The company is advancing its progress and received very positive feedback from industry leaders in the field of colorectal surgery during an international conference for SAGES held in Canada earlier in April this year. It has also been selected as a finalist from a total of 400 companies internationally for a spot at the coveted MedTech Innovator Award end of this year. Nonsurgical, under the guidance of founding CEO Zhou Fangzhou, has worked very closely with internationally acclaimed surgeons like Eric Haas, Barry Solke, and Surendra Mantu, who act also as clinical advisors to the company. We look forward to seeing more progress in the company. And until then, I'd like to hand it back to Todd for now.
Eric, thanks very much. We should take note also that in hand with the progress and advancement and maturation of many of our companies in Singapore, that 6 of the medtech companies are actually currently raising funds. 3 of them are in a very interesting special purpose vehicle that may represent an investment opportunity of interest to some. And if anyone's interested in learning more about these companies that are raising money, please be in contact with us. You may contact Eric or me or anyone at Trendlines to further discuss this. Now, we've got a really exciting event coming up, AgriVest. We're the founder of AgriVest, a very important conference, and we are the principal organizer of the conference as we have been for the last 11 conferences. And we're extremely proud to note that AgriVest is widely considered to be one of the leading AgriVest conferences in the world. And it brings together hundreds of participants from around the world, entrepreneurs, inventors, industry leaders, the strategic companies that dominate the industry. They all come to join us at AgriVest, as they will again this year at our conference on November 6th in Tel Aviv. It's part of a whole agri-food tech week that's been developed in Israel, of which we take up one day with our activities. But it's a full week that's dedicated to the agricultural and food technology sectors. This has been a sellout conference, and if you're interested in learning more about it and joining a significant number of visitors this year from Singapore, along with a delegation from Enterprise Singapore and Singapore family offices, if you'd like to find out more and get tickets to the conference before it sells out, again, please be in contact with us, and we'd love to see you there. And I think that that takes us back to Shira.
Okay, thank you, all of you, Todd, Steve, Chaim, and Eric, and especially our participants for being patient while we lost you for a few minutes there. So this is a reminder to send any questions that you have using the question and answer function. We already have a number of questions, so I'll proceed with reading out some of the questions and then pass on to whoever to answer. Okay, so the first question is, when can shareholders expect dividends?
It's a wonderful question. The answer is really as defined in our dividend policy that we announced a year or two ago. And the dividend policy says that we will pay dividends out of exits, provided that the company's board of directors determines that it has enough cash on hand to meet its cash needs. So we have to have two conditions met in order, according to the policy, to pay dividends. One is to have an exit, and the second is to have sufficient cash on hand in order to meet our operating and investment needs. I think it's that simple. That's the rule, and that's what we intend to stick to.
Right. Well, actually, what I wanted to add, Steve said at the end there, which is we really want everyone to understand that our policy is clear, it's published, and we're really looking forward to implementing that policy and providing distributions via dividends to our shareholders.
Okay, another question is about exits. Are there going to be any exits this year? We're being asked.
Well, answering a question like that directly, unfortunately, presents quite a challenge for us. We, as everyone knows, we do not give guidance, and in matters of exits, it's really valuable to understand that we are often in conversations about the sale of portfolio companies, and we don't announce that in part because not all of these conversations go the way we might hope. There can be a whole host of reasons for that. These are long, complex negotiations that include dealing with many parties, with the shareholders in the company, with the executives of the company, and of course, one or more potential acquirers. So with apologies that I can't give a direct answer to that, I encourage you to take note that I don't think there's a time when we aren't in conversations about potential exits. And I would simply add, we're really excited about this year. As everyone saw, our financials for first half were strong, and we look forward to ending the year strong.
You know, I'll just add that the policy, the strategy change that we announced last year really was intended to free up management resources as well as capital to push to exits. I don't think that you can imagine how much time and effort and capital are required to start new companies. It's not a minor issue. We were reviewing, as we mentioned in the past, more than 600 opportunities a year, narrowing it down. It's a long, complicated process, and at the end of that process, then bringing those companies into the shop where we needed to provide them with significant capital and with significant management time and resources in order to manage those very early stage companies. Today, all of the capital, all of that management time has been freed up to focus on our existing portfolio companies, and that focus is on getting to exits. So I think that I know that we're very optimistic about seeing the results of that quite soon, as we've already seen in the earnings report for the first half.
Okay, another question that we've been asked is, what's the update for Epifix and Stematics? So can we have a quick, even though we've published announcements about this, can we have a quick update so that people can hear it here?
Right, Sherry, you correctly note that we've made a number of announcements, and I can refer people back to those announcements. But in summary, the acquirer of the company, which is a large Europe-focused multinational corporation, the acquirer of the Stematics assets, as of I think it was about a year ago, perhaps a year and a half ago, they concluded that they were not in a position to continue to invest in and support that that particular asset, and they discontinued the revenues. This resulted in our completely writing off the value of Stematics, and it's a sad end to what we felt was a very, very important opportunity.
And AgriVest was the other half of the question.
Oh, I didn't hear the question. I'm sorry.
It was about AgriVest and Stematics.
Okay, what was?
Same question.
Okay.
Status.
Okay, so thank you. So on Epifix, sorry, completely missed it. This is a company that was sold to OrthoPediatrics in the US, a publicly traded company. So once again, if you want to dig in and look at information, you can look at OrthoPediatrics financial statements, which make specific reference to the Epifix acquisition, and they continue to report on their success with Epifix at every quarter. That particular exit, the sale of Epifix to OrthoPediatrics, was a combination of a fixed price that is delivered to us in cash and in stock, and also the potential for an upside. Now, critically, it needs to be understood that that's a potential for upside. Everyone may remember that when we sold the company, it was on April 1 of 2020, I believe, was the closing date. And what everyone may remember is that was pretty much the day that the whole planet realized that COVID was everywhere, and everything began to shut down. So unfortunately, we believe that substantially reduces the likelihood of our receiving additional payments beyond the guaranteed payments, which are meaningful. We are, in retrospect, very pleased with the exit, a little bit disappointed that we no longer anticipate receipt of upside payments beyond the guaranteed payments.
And in fact, at the end of June, I believe we eliminated that upside completely from our P&L, which was an expense against the P&L. And despite that, we still reported the $4.3 million profit.
Maybe just to add to that is the vast majority of our receivables in our financials includes $2.5 million receivables from the guaranteed amount from the Epifix exit. So there's still $2.5 million in stock and shares to be received from the Epifix exit.
Thank you.
Okay, so that I think covers that question. Here's a question about funding. It relates to Escala specifically, but I think it has meaning for all our companies. Does the EIC funding for Escala lead to a dilution in Trendlines equity in the company?
Good question. So the funding was provided in two parts. In rough numbers, it's a total of a bit over €5 million. The grant part, which is I think about 2.2 million euro, there is no dilution. This is a grant, and not only is it a non-dilutive grant, but the grant is not paid back to the EIC. So it's just a straight out grant with no payback. The second part, which is right around 3 million euro, this is equity funding, and the EIC will invest on the same terms as other investors. This company has a financing round that's pretty far into process. And again, the grant part is separate. It doesn't in any way affect the cap table or the company's payables. The equity part will be combined with others, and yes, this will provide dilution to any investor that does not participate in the round per capita. And Trendlines, as is typically the case in larger rounds, does not anticipate participating in the capita, so we will see some dilution. I would simply add, as was noted earlier, this is a company that we're very optimistic about. Received second FDA approval, FDA clearance just recently. Has started doing, I think we're up to about 50 cases in the US now, and just with excellent results. Very excited about this company and its potential going forward.
Sure, I'd like to add just a word about the idea of dilution and the issue of dilution, because while on the one hand, of course, at the exit, we would like to have the largest possible share in a company. On the other hand, the companies in our portfolio, being very young, must raise additional capital. And so what we're really focused on is less our percentage in the companies as on the price per share of the companies, and making sure that that price per share goes up over time, so that the value of our holding increases over time. And in fact, despite the fact that we always see dilution between the time that we start a company and the time that we exit the company, our average return on investment in the 10 exits we've had to date is 9.5 times our investment. So even with the significant dilutions that we have, we still earn almost 10 times our investment amount when we reach the exit.
And maybe to add to that is even to take a Scala, for example, before this coming round, we are holding more than 40% of the company. So we are still holding a big chunk of Scala prior to this coming round, and probably also after the round.
Thank you, Chaim, for adding that in. Okay, the next question is about the non-IFRS values. So I noted the inclusion of the non-IFRS value in the presentation. Non-IFRS standards refers to accounting rules that are not based on the IFRS framework. Can the management explain some of the main key differences between IFRS and non-IFRS standards to derive the higher value? So first of all, I want to add that on slide 28, you can read the full explanation of that, of the differences and how it's derived, and that was posted to the SGX and our website, so you can have a look at that. But I'll let you guys weigh in on a summary version of that.
It's true that slide 28 has the detailed explanation, but the simple explanation is much easier. There are three issues that we take into account in the non-IFRS valuations that are not reflected in our book values. The first and the easiest perhaps to understand is the consolidated companies. We have 8 Singapore companies here at Trendlines Medical Singapore that are consolidated in our financial statements. Because those companies are consolidated, their value is not reflected in our portfolio value in any way. We take the value of those companies, the estimated value of those companies, and if we take it out of and we add it into the portfolio value, that's the first factor. The second factor is using the valuations of companies without taking a discount when there's an investment in preferred shares. Typically, the valuation firm, when we have an investment that is through preferred shares, will discount our ordinary shares by around 35 to 40%. But despite that, our experience has been in all of our exits to date, the exits were large enough that preferences no longer had any impact on our valuation, on our share of the exit. So we feel that the discount, although required by accounting rules, leaves something to be desired when looking at the real value of the portfolio. As a result of that, we take the full value without the preferred share discount. That's the second factor. The third factor relates to companies that have raised capital through a safe instrument. Companies raised through a safe instrument, technically there is no change in the valuation of the portfolio company, because the valuation has not been officially set. Yet in all of those safe instruments, a valuation is mentioned as the cap for the conversion. We take those caps and we apply them. That's the third element in calculating non-IFRS.
Okay, thank you.
And as Shira said, slide 28 explains it in a more detailed and technical way.
Okay, here's another question that is related to AgriVest. Is Trendlines intending to hold on to orthopediatric shares, or management be liquidating the shares in exchange for money? What are the considerations?
So we make those decisions as they become appropriate. In accordance with our agreement with Orthopediatrics, when we do receive shares, they're under a 6-month lockup. After the 6-month period, we're free to sell as we deem appropriate. We have a bias toward exiting such equities. We're not in the business of holding equities in other public companies, but we watch the market and we try and make our best informed decision as to when we can exit, with a desire to exit earlier rather than later.
Okay, I think this is the last question for now. With how things turned out for Agrifood and Stematics, how will management negotiate exits in the future? Does it make sense to sell the portfolio company straight out instead of going for periodic payouts or earnouts?
I would like to say, and I believe it's fair to say, that we continue to learn. And I think that all of our experience, all our cumulative experience for Steve, myself, Chaim, and all of our staff gets rolled into how we approach negotiations and how we deal with all matters of business and beyond. Specific to these exits, if we look back, we can easily explain why we did what we did, and we can also explain how we would seek to do better if we were in those negotiations again. So simply, we continue to try and learn, and in those cases, those were particularly in the case of Amplifix, we think it was a very well run and very professional negotiation between us and the acquirer. In the case of Stematics, much earlier on, this was a sale of assets, and it was a more challenging negotiation in many ways. And would we handle it a bit differently? The answer is we might try to, but one must always remember that we're just one side of a negotiation, and we have to deal with a multitude of parties, as I mentioned earlier, most obviously the acquirer, but we have co-investors in every company, and we have management in companies, and all have a voice in these sorts of discussions, complicating and sometimes improving the exit process.
What I think we can say with a high degree of confidence is that we always look in every negotiation to get the most cash that we possibly can out of the negotiation, and then we look to add to that maximum amount of cash an earnout or a royalty or milestone payments, as I would say, an upside after the deal. But we always look to maximize cash up front.
Okay, so that wraps up the questions for today. We don't have any more questions today, but people are always welcome to send us questions afterwards or at any time to Shira@trendlines.com or to info@trendlines.com. Todd, I'll hand it over to you to wrap up the meeting. And
Very good, very good. Look, so we just want to thank everyone for joining us today. And we want to note that we remain fully committed as a company to our mission of investing to improve the human condition and to continuing to invest in medtech and in agri-food, because these sectors are significant to impacting all of our lives and have the opportunity to build great value for our shareholders. I think it's fair to say, and even the regulators would not protest at the following comment, that we're pretty much guaranteed that the business of food and the business of medicine will continue to grow in the face of a growing population, in the face of an aging population, and that both of these areas perfectly help us to serve our mission of working to improve the human condition. And as Shira mentioned at the start, we're in Singapore this week, and we welcome meetings with anyone who'd like to be in contact with us. And if we can coordinate schedules, we'd be happy to talk to folks. And Steve and I are very often in Singapore. This just happens to be an opportunity to address all of our shareholders this week from our offices here in Singapore. We thank you very much, and we look forward to joining you again before very long.